It is September the 16th, and it is 9 o'clock. My name is Ann Becknell. I'm the treasurer of the governing board, and I'm going to call our meeting to order. If you can and would like, please stand with me and say the Pledge of Allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you very much. We have established that we have a quorum. We have 5 members present, and we also have 4 of our committee members coming in via Zoom. So I will give them an opportunity to speak when we're going through committee discussions. The meeting procedures is the next thing we have to do. I need to read out this meeting procedure statement. The governing board and its committees conduct all of their meetings in compliance with Arizona Planned Community Association open meeting laws per ARS 33-1804 and in concert with RCSCW bylaws, policies, and standing rules. Parliamentary procedures as outlined in the most recent edition of Robert's Rules of Order will be followed in all meetings as appropriate, consistent with Bylaw 3.07, Procedures for Owner-Member Meetings, and Standing Rules 2 and 3. This was adopted by the Governing Board on January 23rd, 2025. Thank you. I'm going to move right on to point 2 in the agenda, which is the approval of the minutes. The minutes were posted from our September 2nd meeting. Are there any comments or concerns about those meetings? Committee members?
No.
Anybody online have anything to say? Thank you very much. We're going to pass on number 2, and we're going to move on. I'm actually going to make a little flip in the agenda. We originally were going to have Cliff do his financial presentation and then have Cap Trust give us our reserve fund performance presentation. But we're going to go ahead and let Cap Trust go first so they don't have to listen to the Cliff presentation. Oh, I'm sorry. Was that my out loud voice? I am so sorry. Thank you very much.
I love the Cliff presentation. All right, my name is Nathan Erickson with Cap Trust. I'm joined by Carol Romney, Ryan Rafidi. I will go through some economic commentary, then Carol will come up and present on actual performance of the portfolio. Feel free if you have any questions to stop me at any time. I like your new setup. It's very, very nice. We don't always have a cartoon. We thought this one was interesting in terms of how we sit in the world today, and we'll have some additional slides to touch on that as well. From a broad asset class standpoint and markets overall, it's actually been a pretty good year, and all of this data will be through June 30th as it relates to the portfolio's report on June 30th. So you can see on the right-hand side, the solid bars represent the full year-to-date performance. The best performing areas of the market for the first 6 months were developed international stocks, up almost 20%, and emerging market stocks up just under 16%. See large cap in the tan. I got a laser pointer here. Yeah, anyway, large cap in the tan up 6%. If you go all the way to the far left in kind of the teal color, small cap down about 1.8. If we were to look today, large caps actually up around 12%, small cap closer to 7%. So markets continue to do well as the year goes on. And then fixed income, you can see here up about 4%, but we've had some pretty material moves in interest rates recently. So that's even better, I think closer to 6% so far year to date. I do like to look at this chart here on the top right just to give a sense of where interest rates are, because that up until the most recent change in the asset allocation has been pretty material to the Sun City West portfolio. So as of the end of 2024, the 10-year Treasury yield was at 4.36. As of the end of June 2025, 4.24. So not much movement there, although if you look at it today, we're down around 4.04%. So pretty material movement in the last couple of weeks. We present our headwinds and tailwinds. So as we look ahead at the economy and markets, what are things that could be challenges? What are beneficial? So a lot of policy uncertainty creates some headwinds, particularly as it relates to the Federal Reserve and their path forward, although there's been some clarity on that recently. They're meeting today, expected to announce tomorrow what their plan is for interest rates, and the vast majority of market participants think it'll be a 25 basis point rate cut, with the expectation that we'll probably see a couple more through the end of the year. The other major policy uncertainty is related to tariffs, which have moved all over the place over the course of the first year of the Trump administration. We have a slide on that I'll touch on a little bit as well. Some long-term detractors, the size of the government debt continues to be concerning, as well as the fact that the labor force is shrinking as people get older and retire, and we have limited the amount of immigration coming in the country as well. So that puts pressure on the labor market, for the broader economy. On the tailwind side, corporations are still doing very well. You see some record high stock prices and earnings coming out of Wall Street. And then the expectation that AI will continue to fuel productivity as well. We put this chart in here. I think it's a good look at stock market returns over a long period of time. So it goes back to 1980. And if you just look at it broadly, this is the S&P 500, you'll notice that most of the time you have a positive return. It's 75, 80% of calendar years you have a positive return. And then in years where you do have a negative return, for example, 1981, 1990, most of the time you have several good years after a bad year. The exception being the dot-com bust in 2000s, where you had 3 bad years in a row. But other than that, a bad year is usually followed by several subsequent years. But what I want to point out are these red dots. So in pretty much every single year, you have at some point an intra-year decline of some amount. This year is no exception. In April, we were down 19% in the S&P 500. So if you react to that in the moment, chances are you're going to miss out on a good year if you're just responding to what could be a short-term decline. Now, granted, there are years where that decline sticks. 2022 is a good example. We all saw that from a stock market perspective. But again, 2022 happened, and now we've had 23, 24, and potentially 25 of subsequent good years. So I think it's good to just take this 30,000 foot view at markets, especially as you move more into equities, and keep in mind that if you're invested for the long term, the probabilities are on your side that you're going to have a good outcome. Speaking of tariffs, this is a look at tariffs going all the way back to 1900, so 125 years of tariff history. You can see where we were at early on, close to 30%, but then a steady decline down as economies globalize and we trade internationally with each other. At the peak of Liberation Day, tariff rates were back at levels we hadn't seen in 125 years, and then have since adjusted down. So this is as of June 30th, around 15%. The last data point I saw is roughly 19%, which is better than 30, but still the highest level of tariffs we've seen in 80 years. So you can understand why it's challenging for corporations to adjust to that reality, and we likely haven't seen the full impact of tariffs on pricing yet. But we'll see how that plays out. I think, again, going back to the uncertainty aspect of it, the challenge is that it continues to change. And so if you have to operate in an environment where you've got new tariffs, you have to make decisions about, well, do I move my manufacturing or move where I'm importing goods from? Do I start building a factory locally? It's tough to do if those laws may change, a month or two from now. So that's the challenge, I think, in corporate America today. I mentioned government debt. So on the left-hand side of this chart, you can see the 2025 federal budget spending on the left column, where revenue comes from on the right column. Today, this is the 2025 budget, about a $1.9 trillion deficit. So that needs to be funded by borrowing, issuing treasuries. This does not capture any revenue from tariffs. That's estimated to be about equal to corporate taxes. So maybe there's another $500-600 billion of additional revenue coming in. It still leaves a pretty material deficit that needs to be financed. And that's where the concern is long-term, is if you look on the top right, that deficit level is projected to be in the 6 to 7% of GDP for the next decade. And that just continues to add on the bottom to the federal net debt over time. So this is not new information. A year ago, we were talking about the same thing, and the year before that. Like, this is an ongoing issue. The market hasn't really reacted to this in the sense of saying, well, we're concerned that the U.S. is not going to pay back its debt, and so we're going to force interest rates to go higher. But I don't think this is a problem you want to push until something breaks. So, we don't have any influence on that, but hopefully at some point Congress will take this growing concern into account and make some adjustments in terms of spending. This is interest rate projections, and this is a dated chart, but we will get a new dot plot on Wednesday, which will tell us that those blue dots on the far right. But this just looks at the federal funds rate going back to 1993, the path that it's gone, and the blue and green dots are, the blue are the Fed's projections of interest rates, the green are the markets. So the market also prices in expectations of where rates will be going forward. And so back in June, they were projecting basically 3 rate cuts to end the year around, they priced it in a range, so it'd be 375 to 400. Today we're at 425 to 450. We may end up with the same dot plot at that point, but following this, we had a number of data points that would have moved these things around. So again, I think that's what we'll see tomorrow, in terms of a quarter-point cut and expectations for 2 more through the end of the year. I'm glad this showed up on some of our pages. The right side doesn't show up, but lots of talk around the Fed, the construct of the Fed, and specifically Lisa Cook, and could she be fired? I'm not going to get into that, but I do think it's relevant to think about the construct of the Federal Reserve. So on the left-hand side, you have 7 Fed governors who are appointed, and then the right-hand side, there's 5 more Fed governors that represent each of those regions. So think of it as 1 from each color there, and they rotate through. So there's actually 12 voting members of the Federal Reserve. So when you think about the idea of firing Jerome Powell or firing Lisa Cook, that's 1 or 2 votes potentially of 12 influencing Fed policy. And the Fed was very clear in Jackson Hole a couple weeks ago, asserting their independence, that they're focused on the data. They're not focused on the policy or the desires of the administration, and that's important, because if you do have influence from outside of the Federal Reserve, then people lose confidence in their decision making. So I think this is why, while you've seen lots of headlines around what could happen with Lisa Cook or Jerome Powell, the market again hasn't really responded too much to that. Now, if that changes, you will see more volatility, particularly in interest rates, probably in the dollar as well. But for now, I think the Fed independence is relatively secure. Just to touch a moment here on international, and while this hasn't had as big as influence on the portfolio previously because we only had 10% in equities, we'll talk about the change coming in terms of, or that's already been implemented in terms of increasing exposure to equities. But looking at what's driven such strong performance in international markets. So I'll focus on the left-hand side, the third section with those 5 bars, and the first one there, which is the Eurozone. Let me try this again. So this column right here. What you see is that the Eurozone year to date is up 28.7%. And then it breaks down what's driven that. And that kind of purplish color there is currency, meaning the value of European or of euro dollars has increased relative to the US dollar. And that's also reflected in this chart in the top right, where you can see on a relative basis, the dollar index down 11% relative to foreign currencies. So that's been a big tailwind. I'm happy to talk about why that is, but that's been a big driver of markets. The other aspect of international markets, the other aspect of gray is just valuations. So if you look at how much it costs to buy $1 of earnings in the US relative to how much it costs to buy $1 of earnings in Europe, it's been a lot cheaper. And I think part of the performance this year is reflecting that people have moved to that cheaper market on a relative basis. basis. So that's reflected in this chart, which shows just the discount that historically you've seen between the two markets and where we're at today. So historically, it's been about an 18%, I think it's 18% discount. Today, it's 38% and slightly moving up. That's part of the performance as well. So aside from that, lots of European countries are focusing more on developing their own economies with tariffs and concerns that the U.S. is not going to buy as much from them, as well as their own defense spending. So that's contributed to performance as well. And then this last chart, this one gets a little bit technical, but it ties all the way back to the cartoon. But when you look at risk in the market, one of the ways you can price that is how much people are requiring in interest rates for a corporate bond relative to a government bond. So you think of a government bond as completely safe. The government will never default on its debt. If I'm lending instead to a corporation, there's a risk they could go out of business and not pay me back the money that I'm owed. So the difference between those two interest rates is called a spread. And so I'll just focus on this table up here. Historically, the spread, or the premium that a corporate bond required relative to a treasury bond, was about 1.5%. Today, it's about 80 basis points. So in the terminology of markets, they would say spreads are tight. Essentially, the market is saying, I don't need as much of a premium because I'm not really worried that a corporation is going to go bankrupt, because the economy is pretty healthy, things seem pretty good. When things get bad, like when you look at 2008 here, spreads widen substantially. So here they're saying, oh, I need like 25% more of an interest rate premium relative to a government bond. Or here in COVID, I need like 10% more. So if a treasury is paying me 4, you need to pay me 14 if I'm going to lend to a corporation. So that's just a way that the market kind of prices risk. And then the other way you can look at it on the top right is how many corporations have been defaulting. And these letters just represent different ratings. So double B is better than single B, which is better than triple C. So you can see 25-year averages there. And then on a relative basis, the last 12 months, substantially lower than the 25-year average. So not only is the market not asking for a lot of premium, companies aren't actually defaulting or not paying their bonds back. So, I can go all the way back to the cartoon and say, no concerns around recession right now. So, any questions or comments on any of that?
Thank you, Nathan. That was very comprehensive.
More comprehensive than you wanted, Ann?
No, it was just very comprehensive and very tiny print, I might add.
Sorry, yeah.
That's okay. So I'm going to ask for Carol to come up and conclude the presentation. Thank you, Carol.
Good to see you all. Okay, on to the good stuff, the portfolio review. We've had some activity over this last quarter, so I'm going to spend a little time pointing out some changes that took place, as well as with the investment policy statement, which is our directive. Does this point? Oh, it does. Okay, great. So first thing, pointing out, this is June 30th, and the portfolio ended up year-to-date almost 28.2 million, with a net investment return of almost 1.5 million. Now, what this is not including on this portfolio reporting is the cash reserve account. And so I do have one more report interquarter that just shows the asset allocation, including the cash reserve account. And I will pop on that in just a moment. And the reason I point that out is because in June, we did update the asset allocation to 25% equity, 75% fixed income. At a glance, if you look at this, you would think that CapTrust is not managing the portfolio appropriately, but once you combine the cash reserve account, it is right on the targets there. So I will show you that in just a moment. Looking at returns for year to date, portfolio just a little over 5% return. A large chunk of that came in within the last quarter. And I will also point out, with our new asset allocation, we generally have a benchmark and we stay consistent with that benchmark. by updating the asset allocation and the directive in the investment policy statement, we did make some changes to the benchmark that we will use going forward. And also, it's worthy to note that the portfolio changes took place in June, which was interquarter. And so the old benchmark was used for the first part, and then we used the new benchmark for the second part. So the reporting on this one just has some behind the scenes explanation, but going forward, we'll be consistently using the new benchmark, and I'll point that out in just a moment. Just looking at some of the returns, if you were listening to Nathan's narrative about the economy, we had international stocks did really, really well, and I'll point that out here in just a moment. That's driven both by valuation and the dollar declining against some other currencies. Fixed income was also positive for the quarter and year to date, about 4% on fixed income. So we reduced fixed income down from 90% to 75%. It still performed positive, so you got that exposure. Anytime we redo asset allocation, as Nathan pointed out, that bar chart that has, every year you have values going up and values going down, and we never know what's going to happen. Happy to report, though, that out of our control, we did have positive in U.S. equities as well as very much so in international, and you increased your allocation to 25% and were able to achieve higher returns on that. At some point, it will go down the other way. We don't know when or how, but all of these are producing dividends and interest. So if the market, when it does turn, you will be picking up some of those at a lower valuation point. And that's just how you build wealth in a portfolio. So U.S. equities year-to-date 5%. You can see just in the last quarter that was about 10% on the portfolio, which is a nice return. And more exciting is the international current year-to-date 19%. And you were able to collect about for the quarter about 11.5% on the portfolio. I do want to point out on this slide here, worthy to note 23, this is the benchmark, and just illustrating the old benchmark and the new benchmark that we're using, which is weighted against the new 25% equity, 75% fixed income. And we also included, because we have the directive now for a short-term reserve for those projects and things that are coming up that you want reduced risk and you want to be able to preserve that cash, we introduced the floating rate bond on those monies. And then I'll just pop over real quick. So this is just illustrating that once after June, we did begin combining the reports. So I'm just here to validate that yes, CapTrust is managing the portfolio according to your directive. This is ending August 31st. And we do have, when we combine both the cash and the main portfolio together, we are on our targets of 25% equity and 75% fixed income. Just going to scroll through several pages here. We monitor each investment in the portfolio. We utilize passive index funds. Let me just get down to portfolio expense ratio 0.06%, which is very low using passive investments within the portfolio. So basically getting direct exposure to those various asset classes. We are just slightly less than the bond aggregate as far as fixed income goes, meaning that we are just a little bit less sensitivity than the bond aggregate, which is our benchmark. And we're moving closer to the bond aggregate sensitivity. And one more thing I'll just overview is what we did for the quarter with the new asset allocation. Slide 62 is just illustrating what we sold, what we bought, trimmed a lot of the fixed income and some of the equities, and then what we bought here on the fixed income and equity side. Oops, I'm sorry. Let me just show you. It was on the, I'll go back. Here we go. This is on 59. 59. We keep track of all the trading that we do so we can summarize it with you. And here we have our, I don't know what happened there. Sorry. Well, there is a slide in there that shows you all of the, if you can go back to that one, I think it was 60, go down to the 60s there. And then I wanted to show you one tactical move that we did just to put a nice little bow on all of the activity in the portfolio. Okay, can I flip through this? Okay. Backwards here. Here we go. Okay, so 59 illustrates that the buying and selling that we did, selling, trimming the fixed income and buying more of the equity space. And then just one tactical move is we moved out of a small cap value and into international, which actually worked well for us because international has been doing really well for the year. So that was just a tactical trade that we made. And then just to confirm on the investment policy statement, we did update those targets to 25% equity, 75% fixed income with bands. And we did introduce the new benchmark in the investment policy statement as well. And we are in compliance with that.
Thank you very much. And this entire presentation is attached to the agenda for anyone who wants to scroll through and look at these spreadsheets and this information in more detail. They can do so by going to the agenda for Budget and Finance today and clicking on your presentation. Thank you very much. At this point, I'm going to open up and see if there's any questions from the committee. I see no questions on the committee. Are there any questions online? Okay, there's no questions, no comments online, so we'll go ahead and move forward. Thank you very much. So we're going to take one step back, and we're going to ask Cliff Swan to give us our July and August financial review. Thank you very much, Cap Trust.
All right. Good morning, Director Becknell and committee and community. Happy to present the financial results for August year to date. It's early days, of course, so you know, we'll roll through this presentation and give you an update on where we stand through August. So again, when we do these financial presentations, we present the operating budget year to date and for the current month, and then we also take a look at the capital related impacts for year to date and the current month, and it's for budget and prior year, for both of those. And then we take a look at our capital improvement budget, and then finally we go over the fully funded balance and the reserve fund impact. So taking a look at the monthly year to date and actual, for August of this year compared to August budget, we finished $25,000 favorable in revenue, mainly due to the sports pavilion. The sports pavilion was closed for half of the month last August for cleaning, and so Gary, our sports pavilion manager, last year said that he was going to do that differently so we didn't have to be closed. So you can see what the financial impact is on that. So kudos to him. Looking at the expense structure for the month compared to budget, we finished $67,000 favorable. Again, these are kind of early days numbers. Landscape maintenance and repairs and maintenance, a lot of those things are kind of timing related. So we'll have some fluctuations, monthly fluctuations, throughout the year in those areas. And then looking at the total monthly income from operations, we finished $92,000 favorable to budget. Comparing that to prior year, we finished $75,000 favorable to prior year. Held the line pretty good on expenses year over year at 22,000 unfavorable. Looking year to date, we're 75,000 favorable year to date. Golf and sports pavilion are favorable to budget, and that's just we had more golf rounds. We had about 1,500 more golf rounds through August this year versus August of last year. So for the first 2 months of the year, so that's good. And we talked about the sports pavilion already with the being open longer or being open fully in August. On the expense side, 111,000 favorable. We have 112,000 favorability in wages, benefits, and taxes. We had a really nice windfall in our employee insurance premiums for 2024, and based on the way we structured that agreement, we actually got a rebate, a $67,000 rebate from Aetna, and for our 2024 claims versus premiums, the way we structured that contract. So we were eligible for a refund, and we booked that in July. So that's driving that 112,000. So that was a good thing for the association, and we'll see how the new year comes along. 2025, we're in the middle of that, obviously, or 8 months through 2025 in terms of our insurances. But that was a pleasant surprise. So overall, 111,000 favorable. Again, early days on some of the other line items. They do fluctuate from time to time. So we'll just have to monitor as we go through the year. So overall, 186,000 favorable to budget. We're operating right now at a $918,000 cash outflow, which is typical for us in the first 5 months of the year. Compared to last year, we're 195,000 favorable to last year. So because of that $67,000 favorable variance, we're only 65,000 unfavorable to prior year in salaries, wages, and benefits. Okay, switching to the capital section. APFs have kind of, it's been a little weird. I mean, I think we were approximately 30 APFs behind last year in August, but in July we were 22 ahead. So it kind of came back and forth. You'll see that on the year-to-date number, but 162,000 unfavorable on APF fees. I'll show you what it looks like year-to-date because we had a swing the other way in July. So, and as we sit through September, we're right on where we were last year through the first half of the month. But looking at the investment income, a little favorable on investment income at 81,000, and then looking at the unrealized gains and losses or valuation change in our reserve fund portfolio, we were positive 423,000 in the month of August. Compared to prior year, we were approximately 30 APFs behind prior year, which of course would give us a negative variance in the APF revenue. But if we take a look year to date, it's only 53,000 unfavorable to prior year. We're about 11 or 12 transfers behind last year. Again, early days, the market can be finicky and fluctuate and be volatile, the real estate market. So we'll see how as the year goes along. But 53,000 on $1 million isn't too bad of a blip on the radar. But we'll keep an eye on it, of course. But overall, looking at the unrealized gains and losses, the valuation change, we're positive 395,000. With that investment income, over $500,000 in positive valuation in our reserve fund portfolio. Pretty good through the first two months of the year. So we'll see how that goes too. Compared to last year, tracking a little behind last year in APF revenue, and then looking at the reserve fund performance, we had a better August last year. A better July last year than we had this year. We finished about 60,000 favorable in July this year versus 400 or so the prior year in July. So, but we'll keep an eye on that as well. Overall, like I said, over $500,000 in positive reserve fund, either investment income or valuation change in the reserve fund through the year is pretty good. Talked about it, 11 APFs behind last year through the first 2 months. Fortunately, we did have a APF rate increase, so that's offsetting the variance in the total transactions in terms of the revenue, and then again the valuation change in our reserve fund, a little behind last year, but still very good. Overall, 166,000 unfavorable to prior year. I'm sorry, past budget. 661 favorable to budget, and then 166,000 unfavorable to prior year in the capital section of the income statement, or overall, excuse me, in the income statement. All right, so now let's talk about our capital improvement budget, and we have approximately $5,150,000 in our budgeted capital improvement budget, and we've PO'd $4.8 million, or if you take a look at what we PO'd and what we have budgeted, we're anticipating a $327,000 savings to our budget through the first 2 months. Early days, but you can see what's driving that. We did PO the pin setters and the whole bowling project that we have with the gutters and the caps and the rail system underneath and the foul lights and the masking units, and that's coming in about 90,000 favorable, which is great. And those numbers are solid. We've got that contracted, and that'll happen in April, mid to late April. We'll start that project in the bowling center. So that's definitely a positive one. And we had about 86,000 favorable in our landscaping and golf equipment. We went and PO'd those as well. So those are two big things, two big projects that are driving the favorability in our capital improvement projects. And then the roof tile replace, those came in very favorable to what we budgeted as well. Looking at our allowances, $420,000 in the budget, and through August we've spent approximately $24,000, and these are the items we spent that $24,000 on in terms of allowance funds through the first 2 months of the year. And then, so how does this all relate to the fully funded balance, and how are we tracking on our fully funded balance? I'll say we're tracking very well. So we have budgeted cash inflows of $8.2 million. We have projected cash outflows of approximately $6 million, and we're running very favorable to those numbers. We finished the year in 2025 at 49% fully funded balance, and we're on pace to meet our 50% fully funded balance for this year, which is in our budget. So obviously we'll track that throughout the year, but right now it's looking pretty. So that concludes my financial presentation.
Thank you, Cliff. I appreciate that. I will look to the committee to see if you have any questions. Rick, do you have a question?
Yes. Question number one is on the capital reserve budget listing. What happened to the projects that aren't done yet from last year's budget, such as the Lizard Acres and the Echo Mesa project? Those are not completed yet, are they?
No, they're not.
Okay, so I mean, are we going to save money on those or not? It doesn't show it here.
Yeah, we don't present those, but we could. If you'd like to see when those projects get completed, we could present.
I mean, we already have the money put into the cash reserves, right? I mean, you got it. The cash is already there.
So how we do that is it's part of our process that we're going through now with CLA and part of our annual audit. And what we do is we take all the projects that were budgeted and we encumber. It's called encumbrances, but we allocate that money and keep it in our operating account.
Right.
Fund it through the reserve fund, to make sure that we cover those projects that are not complete. So once a project is approved in the budget, policy allows us to carry that project forward and fund it. So yes, it's funded. Those projects are funded, and part of our process through our annual audit is to make sure that they are funded in our reserve fund calculation.
But I would like to see what the carry forwards are into this year, because that does affect the cash of this year. Meaning, that you've got the whole listing, there are items that you carry over into next year that are, the funding's already there, but let's see where we are.
If this committee would like to see that, I'm happy to present it at the next Budget Finance Committee.
So, okay.
Thank you. Bill?
Hey, Cliff, could you shed a little more light on that Aetna rebate?
Sure.
I mean, it's you presented like a fact, but is there any like logic behind it? You said it was unexpected. Is there a reason why we didn't expect it?
Yeah. If you look at our track record for the last 5 years and our health insurance premiums paid versus claims paid, it was definitely unexpected. So yeah, that's why it was unexpected. But it is built into our agreement with Aetna that if they hit a certain threshold, and I believe it's 80%, anything above and beyond that, we're eligible for a refund for. So again, you don't know when premiums are going to hit. You don't know when claims are going to hit. So throughout the year, and it's on a calendar year basis, we operate on a fiscal year basis. So we were pleasantly surprised when we received an email from them stating that we were going to be receiving a $67,000 refund based on the claims that were paid in 2024 versus the premiums that were paid. So yeah, it was a nice surprise, and we're not going to expect it in 2025. So it'll be a surprise then too, if we get it.
Okay, and one more item. We're on pace to meet a 50% fully funded balance. Again, I kind of want to do this for everyone else following it. I feel like I understand it. Our bylaws say keep it above 40. We need to be above or at 50 because you're forecasting years in advance, correct?
Correct. Yes. Yeah. I mean, and keeping in mind as well is that 40% is really good for a reserve fund or reserve study assets. But when you're talking about master planning, new projects like IT infrastructure, the things that are going to come out of master planning, all that's new and enhancements. So yeah, I would say you want to strive to make that percentage as high as possible.
Yeah, you presented a slide before showing for at least 4 or 5 year advanced, projection.
Yes.
That's a pretty valuable slide. So I know that you pop it in there every once in a while. It's really helpful.
Yeah, we do that. Absolutely. And that reserve study again, that's a living, breathing document or piece of document, let's call it, that we live by, and it changes on a daily basis. And as we start presenting capital dollars for next year, you'll see that. Yeah.
John?
Yeah, the one thing that stood out to me, Cliff, was how well golf is doing. My memory is good. Last year it lagged a little bit, and I don't think you lowered the budget because it lagged. I think you kept it. So that was good to see. So that's just more rounds, better weather, probably better weather because it wasn't last year's summer, right?
Yes, weather plays a tremendous role in golf rounds. And it was the main driver of last year's deficit. There were some other things. We closed Echo early because we had, we needed to start that irrigation project over there. Of course, we budgeted for that. We budgeted 320. We finished FY24 with 327. So we put that in our budget, but still, it impacted us. And we weren't able to rally at the end of the year, being behind from those weather events earlier on in the year. So, but yeah, it's early days. I'd like to be 1,500 rounds up in the month of March, where the revenue is much higher per round, but we'll take it.
Don?
I have no questions. I think it was stated that he doesn't expect to have any additional rebate from Aetna. And having been in insurance myself and health insurance, it's a good thing you don't plan on it at all.
Sure.
Because you never know. And if we get anywhere near a recession, it will never happen. Because everybody goes and gets everything done before they're laid off. I know. So, no, I think it's a good presentation. Thank you.
Thank you, Don. Is there any comments online? Yeah. I have no comments online. I have comments from the audience.
Zoom.
I can't see. There's a piece of paper, but I can't see.
If there's anyone on the committee
On the, well, that's,
in the ether. Oh,
That's what I was trying to say. You have several committee members who are available on Zoom. Maybe they have comments, Ian.
okay. Let me double check. Dave DeWitt, did you have any comments or questions for Cliff?
No, I'm good. Thank you.
Thank you, Dave. Don Taylor, did you have any comments or questions for Cliff?
None.
Thank you. Mickey, did you have any comments or questions for Cliff?
Yeah, just a couple. So one thing that I am a little bit concerned about it, and is the asset preservation fees, the APFs. And it is early, right? We're only 2 months in. Has there been any discussion about if we continue to see a slowdown in the APFs, or does it look like it's just, timing between the months?
it's a good question, and it definitely has an impact on us because every one of those transactions is $5,400. So definitely has an impact. Unfortunately, we have no control, or very little control, at least tactical control on how and when houses sell in the community. We're kind of subjected to the market. So we're always, I don't want to say we're always on pins and needles, but we're always very in tune with, where we're at. But at the end of the day, we know historically that we're gonna have 1,100 to 1,200 APF transactions in a year, and that's just historical reference. But as far as being involved with real estate transactions as an association, we really have no stake in that. We have no say in that matter. We are, as part of our strategic planning and as part of our strategic initiatives, is to market Sun City West in the best way that we can, and we're coming up with ways and better ways to do that, and with a website update and just various things that we're doing on the marketing front to make sure that we're standing out and still going to continue to be part of the top 10 communities in the country. But again, we don't really have the ability to in the short term make any impact on whether a house sells or not, or interest rates.
Thanks, Cliff. Hey, so just one more comment, and that is that I am constantly amazed at how well we do versus budget. The budgeting process is really well thought out. And when I look at it every single month throughout the year, the fact that we come as close as we do, kudos to the finance team. And this is coming from a former CFO of big companies.
Thank you, Mickey. I'm not sure. Dave Perot, are you online? Okay,
Yeah,
no
Dave?
comment. Oh, sorry?
Dave is online still.
Okay, thank you. All right, thanks, Cliff. If there are no questions online from the YouTube channel, thank you, Cliff. That was a very valuable presentation. And again, that information that Cliff went through is all attached to the agenda. If anyone would like to click on that link that you see in the agenda, you can read through these numbers in great detail at your own leisure. Thank you very much. Moving on to the next item on the list. Yesterday, John Click and I attended a presentation by the Auto Respiration Club, ARC, and I'd like to have John give you a summary of the presentation we saw yesterday.
Okay, for the members present, you have what was presented to us at the meeting from the ARC folks that were there. And then I wrote up my notes and passed them out. Maybe we can email them afterwards. I have a couple corrections to make now that I'm seeing them. So ARC is requesting the well, let's back up a second. The purpose of the meeting was preliminary. When we have a big project, a meeting is scheduled for each of the committees that have input recommendations to the governing board on the project. And so I think the purpose of this was to start that process. So there were 2 members present from each of the Budget and Finance Committee, the Properties Committee, and the Charter Clubs Committee. So this is our first look. We as a committee will make a recommendation on this project, and that recommendation will be due in the budget timeline in the month of November. So again, this is first look, and I imagine in our next meeting, we'll dig into this deeper. Correct?
Very good. Yeah, this was just a preliminary overview. You got to give us a heads up, and we will begin doing the more detailed analysis and gathering all the facts together and putting it together in the coming months.
So very briefly, to go through this. ARC is requesting a completion of their building. They're calling it Phase 3. It is a feature showroom. My little note there of 15 by 25 is inaccurate. It's much larger than that. I think they said that they'll be able to show 4 or 5 autos. It's also needed office space, storage space, and a meeting room that is 15 by 25. The first 2 phases occurred. The first phase occurred in 2016. It was a $900,000 project that was the mechanics building. It's not an arrangement that is paid by Sun City West. It was a loan arrangement, and they offered that they would pay for it if they could have a loan arrangement. They made an initial payment right at the beginning of $400,000 that they raised from their club. They had on hand, or they did fundraising. Second year of that loan, they paid $116,000. So in 2019, they entered into Phase 2, which was the building of their paint and body shop. This phase added $400,000. I don't know, Cliff, was this a separate loan or just an addition to the first one?
It was an addendum to the original agreement.
Okay.
So yes.
Thank you. So all in all, from the first 2 phases, there was $1.3 million that was loaned to ARC, and to date, they have paid $1,078,000 against it. There's approximately $220,000 outstanding to be paid over a 9-year period. They estimate that they could. They've been paying at least $75,000 a year, with the exception of the COVID year. So we're looking at, if things continue, 3 years before the existing loans are paid off. In the COVID year, they communicated with Sun City West because of inability to raise money, and they made a payment of $9,000 that year. They reported on their financial position a little bit. They summarized $204,000 in revenue in 2014. They did not have bottom line numbers. They estimate that their bottom line before they make payments on the loan is at least $75,000 or in that range. They also reported that they were able to contribute $35,000 to charities. They also have a $100,000 CD that they're required to have as a percentage of their assets that they manage. They have that with the bank. Their projected cost for this phase 3, they reported at $800,000 to $900,000 for this project. They are using the original architect. He provided those numbers. Carl provided some caution to those numbers based on costs and the nature of these projects. Ultimately, the cost is determined in the budget process and the bidding process. They also announced that they have a $150,000 contribution for this project for the steel and the fabrication of the steel by a person or a business. That request is time sensitive. It's available to the club for 18 months. And that is to protect that donor for rising costs and things like that. So there is a significant contribution that does have some time sensitivity to it. The notes I wrote down at the end, this is a capital project for the 2026-2027 budget year. This is not a request to have the community pay for it, but it is a request to again enter into a financing situation. The funds of the loan come out of the operating budget, and as they're paid back, they are revenue or income received for the operating budget. I'd ask Cliff to explain that further at the end of this because it went over my head. Practice of loaning money to charter clubs is something that hasn't been done in recent years, but there's not a current policy preventing it. Again, the purpose of this meeting is to provide an initial look to the committees that provide recommendations to the governing board on capital budget requests. There was a side note about part of the current facility called Anna's Courtyard. They've had discussions with the party, and they're in favor of building over that courtyard and renaming the showroom as Dan and Anna's Showroom. I certainly made a few requests for the future for us to evaluate this, or I would make these recommendations. One is to better know the terms of the loans and the payment history that's taken place, get a little more detail from Cliff on the financial performance of ARC, and to better understand the impact of how it affects the operating budget in the year that we make the loan.
Thank you very much for doing that update. That was very helpful. I'll go to the committee to see if there's any questions or discussions. Rick?
So this building is not part of the rec centers, correct? So it doesn't impact our reserve fund, or does it?
So the building is on our fixed asset schedule. So the building is on our fixed asset schedule. The club maintains the building and the equipment in the building. Their budget does that, just like the wood shop, the metal shop, and the other standalone clubs, or any club with a space for that matter. So basically what happens here is if the project is approved, the funds for that project are paid for out of the operating fund, the operating account. We have, on average, let's call it $7 million in that account, in our operating account. So the operating account funds it, we set up a note on the books, which we currently have an outstanding note of $220,000 after the last payment we received from ARC on their current agreement that's in place. And when those funds are collected, they reestablish in the operating account, the operating bank account. So no reserve funds. Member dues in terms of the project are not impacted. There's no member dues that are going to be requested in the budget or in the reserve fund to pay for this project. And then as we collect those funds, like I said, the operating account gets replenished with those payments when the club makes those payments. As far as historical payments, they've approximately paid about $75,000 a year. There were a couple years in there that they didn't. They have 3 years left. If they stay at that same rate, they'll have the loan fully paid off. Their current loan, the outstanding balance is $220,000, so $73,000 a year approximately, and they'll have that paid off by January 2029.
Anything, Bill?
No.
Nothing from Chris? Okay. John?
I'm kind of curious. I'm curious as to where their income is coming from. If they get total income of $200,000 a year, I'm surprised they're only paying off maybe $75,000 each year. It just doesn't. I mean, I have no objections necessarily to increasing the loan to them. I understand their need for having a showroom over there, and probably office space and meeting rooms. But I would like to try to get a little bit more information as to what's the additional money that they are collecting theoretically, like in 24. They're only paying $75,000. Where's the rest of it going? I know they're giving some money to charity, but based upon the charity that I looked at, there's not that much going out in charities. So I'm just kind of curious about their bookkeeping.
Good question, Don. Thank you. And we did bring that up with the members at ARC yesterday during the meeting. And Cliff is going to present us with the full set of financials for the past 3 years for our review, so we can see all the income and expenses that are incurred. I do believe that ARC has proven themselves to be creditworthy, and they have lived up to their debts to this date. So I think it's our consensus at this point that we were going to let them continue on with the project, and let's see where we go from here.
And the terms of this will be another addendum to the existing agreement, and the terms of that addendum in terms of when that has to be repaid will be, determined in the process and approved by the governing board. And so if it moves forward.
Do we have any questions from Dave DeWitt?
No, I do not. Thank you.
Do I have any questions from Don Taylor?
Yes. One of the questions I answered on this is how many members do the automotive?
Hey, Don.
I'm sorry.
Don, let me interrupt you. This is Cliff. You have to turn your volume off on your computer because we're getting echo.
Okay. Is that better?
No, it's still on.
Then I'll pass.
Yeah,
He asked about membership in the club.
uh-huh.
So last year, in this report, it says they ended with 740 members, up from 707 2 years ago.
Did you have any other questions, Don?
No.
Thank you. Mickey, do you have any questions, comments?
Yeah, the only thing that I'd like to say is that, I mean, it's a big ask, right? It's a big ask, and that we just do our due diligence. They're a very vibrant club, and the fact that they can generate as much as they do. And I know that they do a lot of work, so I know where a lot of the expenditures are going. But it is a big ask, right? That's a big ask, and I think that we have to make sure that perhaps they need to repay a little bit more than 75 a year if they have such a big project. And those are all things that can be determined later.
Agreed. Thank you, Mickey. Dave Pro, do you have any questions? All right. Do we have any questions coming? Oh, I'm sorry. It's another question here.
And I would say, will we get a review of this when we do the walkthrough of the facility?
Yes, so we've been invited to attend a walkthrough next Monday at 1 or 1:30? 1, at 1 o'clock. So anyone that would like to go through the walkthrough that hasn't been there to see this is more than welcome to come from the committee and do the walkthrough with them. And then, of course, we'll receive more information over the coming weeks that we'll be able to review in detail.
I will say the original terms on the original amount of 500,000 was a 5-year term, but there was a 5-year extension that was approved in the contract where they asked for a 5-year extension. So the terms previously would have been 100,000 per year required to pay off the loan if that 5-year extension wasn't written in the contract. And then the second portion of the paint booths was 400,000, and that was actually written as a 10-year note. So historically, that's what those notes have been.
Okay, great. Good information. Any other comments or questions? No comments or questions online? All right, so we're going to move forward. We're going to go to 4.03, which is the financial policy reviews. We have 14 financial policies that need to be reviewed every year. So there's been a few comments made about these the policies over the last few months. I think the best thing to do is to break them up and to assign them individually to go through each of the policies and let us know if there's going to be any significant adjustments or rewrites or red lines to the policy, not just adding the word and or the or but or putting a comma, but are there any significant changes to that? So what I'll do is I will sit back and I will assign 2 to 3 of these policies to each member on the committee to review, and then we will get back together and take our next appropriate steps and make a decision as to how we want to proceed forward. Does that meet with everyone's consensus?
Right.
Hey, Ann, can I make a comment?
Mickey, yes.
So that's what we did last year, right? That's what we did last year. What I would say is, and frankly, it feels like we did it yesterday for many of us on this committee, went through it. And the biggest issue, I just read yesterday, I read every single one. And what I think we really need is not to have it broken up in 2 or 3 for a group. It needs an overall look at it because they are disjointed and appear, and they don't hang together. Okay, is what I would say. I think the policies themselves are great. What really needs to be done is a review and kind of a reformatting. I'm not sure there is, considering what we did last year was pretty significant, I'm not sure there's a lot of changes, but someone needs to go through and actually make them appear to be of the same document.
Thank you, Mickey. Since I wasn't here for that that wonderful party. Although many of you were. How do you feel about what Mickey just said, Rick?
Well, there's a couple of people on this committee that would like to spearhead that, what I'll call consolidation effort, and make sure that there's one financial policy that all these, what I'll call sub-policies, fall underneath, so that we would, and I don't want to throw them out there, but David has done a lot of work on this, and he's even advocate for this. So I know he's out of town and all that stuff, but he would look. You know, I'm not going to volunteer him, but he's very much behind what Mickey just said. And most of us from last year, are in agreement with that.
All right. I've heard different conversations regarding that. I just wanted to get it sort of on the record, give everybody a chance to give their opinion. Bill, do you have an opinion?
I think that would be a good idea, the overall, because I had trouble connecting them together
Connecting the
and
dots.
making it to feel like it was the same thing. Each one was so individual.
Excellent. Chris?
You know, I look at the process. The process in place is to review every year, and we have new members on this committee, and I think that's the whole idea, is to take fresh look every year and let somebody notice it. So I caution a little bit about what I might consider and I'm part of it, the group from last year just continuing their work. I think it's important to have fresh people take a look at the policies. So I might go back and agree with your original suggestion. That'd be my point of view.
Okay. John?
Yeah, I kind of come from the standpoint of, I feel like we just finished. And it took a long time individually for everybody to, come in and give a report, and we kind of wordsmithed them. I wouldn't, and maybe because I was part of the process last year, so I want to be fair to the new members, but I wouldn't be opposed to, we read all the policies, all of us, and we come back and see who has comments on them, and that we concentrate on making it a consistent, thorough document.
Don?
I'm a little bit new to make any comment one way or another, believe it or not. I have pulled off 4 that I was interested in to really take a look at. And I have to admit, it sometimes is a little confusing. So whichever way the committee wishes to go, I'll go along with it, either with everybody reviewing it or just parceling it out to some people. I don't care.
Dave DeWitt, do you have any comments?
Yeah, I think it's a good idea to have new committee members involved, and I guess I think both are good ideas, is to parcel it out, but then maybe come together and look at it like Mickey talked about as a whole as well.
Yes. Don Taylor, do you have any comments?
I think the group would be fine.
Okay. We have a member from the audience, Christine Novello.
So hi, everybody. I'm Christine Novello. I'm the president of the governing board this year. And just to interject a couple of things. First of all, I chaired this committee last year, for those who are not aware. So well familiar with last year's recommendation that I think Mickey and others have stated. One of the things, first of all, this is not optional, right? Because our bylaws, which govern everything that we do, require that every policy be reviewed annually, individually. And the way we do that is some of our committees are responsible as budget and finances for the finance policies. So again, this is not, it may sound inefficient, but there was a method to that madness. And I think the method initially was to have that fresh set of eyes look at the content and ensure that the policy continues to serve our community and our association. So just an FYI, it's not optional. So the individual review isn't really something that you could individually decide to reject. However, Ann and I have been talking at length about how to go about it. So some of you are familiar with the concept of a committee working group. Committee working group, again, there's another policy for that as well. And last year, that is how the Budget and Finance Committee accomplished the huge task of reviewing and updating FY12 and FI4. So, but that required extensive analysis. So should your committee choose to do that, and one of the things that you could do would be to, as a committee, commission a working group to look at that end-to-end read and make a recommendation on the formatting or something like that that you would do for all finance policies. Again, you're only looking at finance policies. So that would be one thing that you could do. The proviso is that the working group always has a charter with a very specific date and outcome. So keep an eye on the clock as well. If it's something that you want to consider doing, you'd need to work on that as a committee, form a working group, make that recommendation, and then you can start actually redlining if that's something that your committee wishes to do. So wanted to give a couple of pieces of clarity on, first of all, it's not optional. Bylaws require the review, but how you do it could be a little different this year, and that's just something to consider.
So based on your experience from having had this job last year, you're saying that it's optional for us to follow the, I guess, basically recommendation of Mickey to form a working group, review all of the policies, and in addition, come back and provide any additional formatting or otherwise that working group would find appropriate.
That's one way to accomplish the goal of looking at everything end to end.
That's right.
Before individuals start to rewrite policy. So that's just one way to look at it, but the content would still need to be accounted for to the governing board. All 14 policies, however you choose to, whatever you recommend in the end. And again, the outcomes of the working group would also go back to the governing board and to our legal counsel for their review.
It certainly seems like the much more efficient way to get where we want to go than to go back and have.
It is an option,
you know,
that end-to-end review. But and again, as just for the information, that's something that the governing board is considering overall. That's a very large task to do for every policy, and if you could imagine, if that's going to be done, that would probably be professionally done if we ever did an end-to-end review. But it's something for finance policies, if you wish to undertake that look, that is something that you could do.
All right. So based on the responses I've gotten from the committee so far and online, it appears that the creation of a working group to review each and every one of the policies and then make any recommendations for changes would be the right way to go. Is that true? You can just give me a nod or yes or no.
And Ann, I'm sorry to interject, just to, but while you're doing the consensus view, the working group, you would need to, if the committee wishes to form one, and you would be responsible for creating a charter for that group to define very clearly and concisely and narrowly the outcome and the dates associated with the outcomes. That's all. I just wanted to, so that part is not, you can keep everybody focused on that way. So, so it would be the end-to-end read and a recommendation on how to proceed forward.
Rick, you were going to say?
I would say I would assign everybody a press policy, come back, and then form a working group on the ones that feel need to be changed and or do a consolidation of everything together. Because realistically, there's a lot of information here, and it's good information. And you have to remember, these are policies. They're not procedures, they're policies. So you got to keep that in mind when you read this.
Okay.
So.
All right. So your consensus right now is that we would assign the policies and then come back together at our next meeting. And then form a working group if required. Bill?
I agree with that.
Chris?
Yeah, I just think, in addition to, I agree with that. In addition to that, I encourage every member of the Budget and Finance Committee to read all of the policies. And then later, maybe I'm assigned one or two, and then bring your concerns to me for the one or two that I have. But I think everybody should read them all and be empowered to make suggestions on any of them.
All right, perfect, thank you. John?
Yeah, I like that process. I would add, last year, we provided input to Christine on some of the policies that we felt maybe we had more experience on. We all bring different experiences, so that would help you decide how to assign them out. So I would encourage we do that again.
Perfect, thank you. Don?
It seems like a really good idea to divide them up a little bit. Everybody read them, divide them up, bring them back with ones you have concerns on, and then form your committee.
Great. Dave DeWitt?
Yep, I agree with Don.
Okay, great. Don Taylor?
Yes, I agree also.
All right, thank you. Mickey Jacobs?
Yep, that sounds good.
All right, then I will go to work on assigning the policy reviews, and/or if there's something you've got specific knowledge of that you've read and you would like to take responsibility for that specific policy, please email me, and I'll get this out to you as soon as I possibly can. All right? Okay, any questions online? And no questions from the audience? So, are there other Budget and Finance Committee research topics that come to mind at this point in time that we need to put on our agenda to consider? I don't see any hands being raised. Are there any from Dave, Don, or Mickey? Then I will go ahead and leave that topic as it stands. At this point, we're at 5.01, which is the committee comments, so I'll start again down here with you, Rick. Do you have any comments today?
Not now. I'm good. I'm done.
Bill?
No more comments.
Great. Chris?
No comments.
Perfect. John?
No comments?
Thank you. Don?
No comments.
Do we have any comments from the folks that are online? Dave DeWitt?
No comments.
Don Taylor?
No comments.
Mickey?
Nope.
All right, thank you very much. So that will conclude the committee meeting, and as a reminder, our next...
And, sorry to interrupt. May I-
you think you get to
Couple-
talk here? Go- All right, Cliff has something to say.
Couple of things. One thing that is on our agenda, and we'll talk about it in more detail, but we are on the last year of our RFP for our auditor, Clifton Larson Allen. And so we typically put a working group together with this committee, and we'll go back out to RFP for audit firms. And so that will need to be on the agenda. So that's an add. And then also, I also want to plug the fact that we have our audit presentation at the next Budget and Finance Committee meeting in October.
Thank you. When is the first audit RFP working group you think required?
I would say we should, after the audit presentation, so we still are engaged with them through tax season and our 401k audits and everything, but we usually start the process, I would say, in November.
Okay.
So I'd like to meet and get the RFPs out, and then by maybe the meeting in January, present who we picked.
Okay, so a working group established sometime in November.
Yes.
All right, thank you very much. Okay, thank you, Cliff, for interjecting that. We'll get that put onto our agenda so we can follow up. That being said, we can close this committee meeting today. Our next committee meeting will be on If I had my glasses here, I could read. It's going to be on October the 14th. We have canceled the meeting for September 30th, and we will go to the meeting for October 14th. Any other questions or concerns? Nothing online? Thank you very much. Meeting adjourned.